Hello everyone, we are Group 1, consists of Arif, Shan, Hamza, and me, Siska. We are following MBA program at IPMI International Business School. Currently, we are attending corporate finance class facilitated by Prof. Sembel. Today we would like to share a summary of book, and the title is One Up on Wall Street by Peter Lynch. This is a great book, so we hope it will be useful for you. Well, stay tuned and enjoy. Part 1, Preparing to Invest. Before we begin our investment journey, first we have to prepare our mind for it. So there are several key takeaways according to Peter Lynch that we could reflect on this preparation to invest. First, about readying our mindset before investing. Understanding history and philosophy was much better preparation for the stock market than statistics, because stock investing tend to be an art instead of full science. People who have been trained to rigidly quantify everything will have a big disadvantage from the perspective of history. Since history will always repeat itself, people who have understood history will realize that it will always be self-defeating. To think that we could create a calculation for us to invest in a bullish market and exit the market just before the bearish started. Logic is the subject that helps us the most in analyzing stock, because it taught us to identify certain things that is illogical in the capital market. We should make up our mind that it's no use to pay attention to investors from forum debating whether a stock price will be up or down. Instead, we should directly analyze the stock and its company itself in the first place. We have to understand that actually the real investing is not a gambling compared to other instruments like bonds. In bonds investing, we are nothing but a lender, so the best we can hope for is to get out lending back, plus interest. Stock can provide high return because as a shareholder, we got the company's growth at our side and we became a partner in prosperous time and expanding business. But in business, there will always be a dynamic process of boom and bust. Hence, we have to understand that no guarantee that a blue chip stock will permanently be a quality investment and its company always in a prosperous time. Therefore, buying a right stock in the wrong time and in the wrong price is absolutely a disaster. We have to be self-disciplined to rely on our analysis instead of relying to herding behavior. We should rely to our fundamentals instead of being swayed by the bullish market or bearish market. What makes Warren Buffett is an all-time great investor is that when he owns a stock that is overpriced, he sticks to his valuation and sold that stock. Instead of being swayed into a blind hope that the stock will continue its rising price to earn him more additional profit. The self-discipline is important because of the market's habit for herding behavior. Stocks are mostly perceived as prudent investment exactly at the moment where they are not, and perceived as speculations also exactly at the moment where they are not. There are a lot of public information in the open hands for us to thoroughly research stock that we will buy if we know where to look for it. There are 3 personal issues that should be addressed before committing to investing. Before we decided to invest, there are 3 reflective questions we should consider. First, do we already bought a house? This is to reflect on our habit to pay attention and consumes a lot of time in thinking over the detail and tremendous nitty-gritty when we try to buy furniture and home appliances. But it didn't take a long time for us to choose what stock to buy. Why we could spend a lot of effort just to buy a home appliances, but couldn't replicate that kind of analytical habit when we purchase a stock. People make money in real estate market and lose money in stock market simply because they didn't spend enough time to stock research, just as they did when shopping for anything related with housing. Second question, do we actually need the money? We should only invest with the money that we could afford to lose, without that loss affecting our daily life in the foreseeable future. Stocks are not for everyone, nor even for all phases of a person's life. Last question, do we have the prerequisite personal qualities? In a word, what never stop talking, we have to be able to differentiate between noisy and informations. We have to understand that by the time the market receives the signal derived from some news, the message may actually have changed. That's why when predicting the unpredictable market, being able to not listening everything is crucial. We should objectively through the fundamental story of the stock itself instead of relying to our feeling and goods. Next, about interpreting what the professionals might say. Never overestimate the skill and wisdom of professionals. Professional investors sometimes could be oxymoronic or contradictory in nature, because instead of being idealistic and fast-paced like they supposed to, they still could act based on groupthink in choosing stock. Because institutional investors like them have unwritten rules. Success is one thing, but it's more important not to look bad when you fail. Therefore, we should take advantage on what we have already know and try to always have an edge on that stock. It will help us to make money in stock so that we will not overly relying to what the professional might say regarding that stock. Next, beware when we choose what stock to buy by following professional institutional investor. There are so many public companies in the market that it made us confused on what stock to begin with to be analyzed. It is natural that we benchmarking to what stocks that a mutual fund or pension fund buy. What we should remember is that there are a strange phenomenon due to general restrictions. Despite all of the research being conducted, big mutual funds are only allowed to buy share of a small cap company, which usually provide the largest risk-adjusted return. Only when the stock's price are getting higher and its market cap are larger, while it actually no longer providing any gain.
Part 2, start to invest. After we have been preparing our mind for it, now we could begin our investment journey. So there are several key takeaways according to Peter Lynch that we could reflect on this beginning of investment journey. About where to begin searching for stocks to be purchased. Choose a stock that close to us in our daily life. The list of public companies is so abundant. Often we struggle to pick which stock should we begin our research. We should choose the one with close proximity to our own daily life, so we know and familiar with the company and its business. Bonus point if we are having a professional age means if we are actually work in that particular industries, because we could always in a position to outguess other person without an age. On what important change about to happen in industry landscape, look for what cluster that stock lies in. Before we jump into the analysis, instead of randomly shortlisting one by one, we have to understand that big companies will not have a big stock price moves. Therefore, Peter suggesting grouping company into several categories to help us in shortlisting on what we have to understand. The slow growers pays a regular and generous dividend but limited room for company and price growth. The stalwart size is definitely big, hence it is not considered as an agile price climber. Though it could provide a faster growth than the slow growers, long enough to make a price climb, but surely offer a good protection during recession and hard times. The fast growers, small, aggressive, new enterprise. Fast growing company doesn't always mean a fast growing industry. All it needs for a fast grower is a room to expand within a slow growing industry. The cyclical company whose sales and profit rise and fall in a regular or predictable fashion. Since most of a cyclical company is quite famous, people tend to mistaken the cyclical company into stalwart. Put a lot of money in it and losses in a cyclical timing is the key, and we have to be able to detect early sign that business is falling or picking up. The turnaround, if our chosen stock is in the middle of turnaround process, we should be careful on determining which type of company or which condition that cause it to have a turnaround process. For it will preparation a very different condition and circumstance to be analyzed. The bail us out or else kind of condition, the who would have believed it kind of condition, the little problem we didn't anticipate kind of condition, the perfectly good company inside a bankrupt parent kind of condition, and the restructuring to maximize shareholder values kind of condition. And the last, the asset place. This is a company that owns something we know really valuable but hasn't been noticed yet by the market. This is where our local edge can be used the greatest advantage.
Now, the second point about this part is understanding what to search for as an investor. This is related with finding what stocks that we should buy. Notable points from these books are: first, never easily jumps in and rushes to buy stock when we heard some idea. When we notice a good stock based on what we've heard or based on our opinion, don't we ever instantly buy it? Doing so is not an investing actually, but it's a gambling. What we've got so far is just a lead to a story that has to be developed. And then, don't judge a company solely based on our opinion on its product. A company might have both familiar and unfamiliar product, but if we're judging one company is good because of the familiar product only, we are forgetting to analyze that product actual contributions towards the company's bottom line, because it is very possible that such famous product is actually only contributing to a small proportion to the overall company's earnings. Third, be rational when looking for a company story. We have to be careful about our myopia. Company can't possibly maintain a high growth rate forever. The high flyers of this year will become the next year's groundhog. Next is, the simpler the business model, the better it is for us to understand what should we looking for. Getting the story of a company is a lot easier if we understand its basic business. Always understand our business. It is important to understand that It is impossible to find the perfect company. But if we understand it though, we can mitigate the risk that might come from that stock. And then only buy a stock after we are able to generate 2 minutes of argument on why we're interested in that particular stock in the first place. Understanding why we choose that particular stock is very important, particularly on the story about what should happen for that company to succeed and the pitfall that stand in its path. In developing a story, depending at the categories, at least we should be able to explain about if our stock is in the slow growing category, we have to explain about what is it in the dividend that we must buy that stock. If our stock is in the cyclical company category, then we have to be able to ask how is their business around conditions, inventory, and prices. If our stock is in the asset play category, we have to be able to answer how much is their unnoticed asset worth. And if it's a turnaround company, has it improving its fortunes? And is the plan are working so far? If our stocks is a stalwart category, then the key issues here are the price earning ratio. So does the price already dramatically risen? And what's the thing to accelerate its growth rate? And if the stock is a fast grower, where and how can it continue to grow fast? That's the point that we should be able to answer. And the next point is about find the company story about something that has a potential to stretch. You see, because big companies have no room to expand, so it is better that we focusing our search for a company with a story about potential room for growth. Usually, if a company does a boring things, we have an edge to buy that kind of stock because it might be sold at a discount. So when it become a trendy stock, we could sell it at a profit to the trend followers. The next point is that focus on the story about that company's earnings. Every stocks will be judged by the market based on its earning. So first thing to remember is that always ask what makes that company valuable and why it will be more valuable tomorrow than it is today. Indeed, sometimes it will take years for such stock price to catch up to the company's value, and the down period may be last so long that we begin to doubt it. But value always wins out. Hence, there are several things that we should bear in mind. Be careful when we buy a stock in a fast-growing industry. In fast-growing industry, we are actually betting on its growth chances to earn money in the future, while actually, it's current actual earnings that will decide the fate of a stock. And then it is silly to solely relying on price to earning ratio PE, but we shouldn't ignore it either. PE levels tend to be the lowest for slow growers and highest for the fast growers, with a cyclical ups and downs in between. But remember to avoid a crazily high one, because it should be followed with crazy earnings as well to justify that high price earning ratio in the first place. We should also be aware of the timing bias upon PE in low interest rate era, because stock price tend to rise because the demand of stock will be higher. And then next, prediction about future earnings is an educated guess at best. There is no certainty out of it. So if we can't predict its future earnings, at least we can find out how that the companies plan to increase its earnings, so we can check it regularly to see whether that plan are work out as well or not. There are 5 factors we could investigate when trying to develop a story about company's earnings growth strategy. Does it have the capability to reduce cost, raise selling price, expand to new markets, sell more product in the old markets, or revitalize losing operations? That's the important point on this part.
The last part is part 3 about long-term view. Many investors have a high expectation from the stock market to yield a 30% return every year, and how to create a portfolio that provides a logical maximum gain but with a minimum return. So these are several key takeaways according to Peter Lynch that we could reflect about long-term view in our investment journey. About designing our portfolio. First, there is no certainty about return in stock investing, no matter how good we are. In certain years, we might make 30% return, but surely there will be years we will only able to create 2% return or even lose 20%. That's just the way things are, and we have to accept it. Second, don't trap ourselves into put our egg in one basket or not debate. Some said we shouldn't put all of our eggs in one basket, and some others say that put all of our eggs in one basket and watch that basket. Actually, the point is not to rely on any fixed number on stocks, but rather to investigate how good they are on a case-by-case basis. But since we might be victims of unforeseen circumstances, at best our portfolio comprises of 3 to 10 stocks. And the third is, no matter how good our portfolio design, it will always about our state of mind. As long as we cannot convince ourselves when the market down 20%, I'm a buyer, and banish forever the fatal thought, when I'm down 20%, I'm a seller, then we will never make a decent profit in stock. Stick around with the fundamentals and you will be amazed that the result in several years. And discuss about how should it be long-term investing. First, the market can be sometimes have a mind of its own. In a short-run stock performance, we tend to confuse ourselves between prices and prospects. Hence, paying attention in a short-term basis without paying constant attention to its underlying fundamentals really bring us nothing good. And second, don't be trapped in our own assumption regarding stock prices. We have heard about some widely common assumption like, if stock price has gone down this much already, it cannot go much lower, or wait for the stock hits the bottom, then I will buy it, bottom fishing, or the stock's already too high, it might be unable to go higher than this, or my stock is fell, I am wait until when it rebounds, then I'll sell it, etc. We should always rely to logical explanation by updating our fundamental evaluation. There is no limit in stocks, where the stocks can always go lower if there is no improvement on fundamentals, and also can always go higher as long as it has chance to further improve its fundamentals. Okay, that's all. The book review summary of Peter Lynch, One Up on Wall Street. Thank you for watching this video. Don't forget to like, subscribe, and comment. Special thanks to Professor Sembel, our beloved lecturers and facilitators, and also IPMI International Business Schools. See you on the next video. Bye now.